Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. All right, Mena and I have another exciting episode today talking about electric vehicles. But seriously, we've got an idea to share with you. If you're in business and you're interested in owning an electric vehicle, either now or down the track, you should listen in because we can help you suggest a structure that might be most optimal for your situation, which again, none of this information in this podcast is advice, of course, it's information only, and you must go and confirm it with your accountant, but we're making some generalization here. If you plan to never, ever, ever buy an electric vehicle, you probably should stop listening to this podcast right now. But there's tax benefits now associated with electric vehicles that self-employed people can take advantage of in the fact that they don't attract fringe benefit tax, which means that ultimately your car could give you a 47% tax deduction. So, Mena, tell us all about it.
All right, so the first thing is we've got to sort of establish what the eligibility criteria is for the electric vehicles. So unfortunately, buying a $200,000 or $300,000 Porsche that's electric won't really be exempt from fringe benefits tax. So there's certain criteria that need to be met before you go down this pathway. So first of all, it needs to be a zero or low emissions vehicle. So again, not a hybrid vehicle and not a plug-in hybrid vehicle. It needs to be completely electric. The first time the car is basically held and used needs to be after 1 July 2022. So you can still have a car that is second-hand that is eligible for the FBT exemption, but it needs to be purchased on or after 1 July 22 or originally purchased after 1 July 2022. And then luxury car tax has to be never been payable on the car. So although the car might have been originally $120,000 and there was a luxury car tax payable and you subsequently buy it, for example, for $80,000, that car wouldn't be eligible because there was originally LCT applied to the original purchase cost. So currently the LCT, the luxury car threshold, sits at $91,387. So the car needs to be below that value to be eligible.
So let's talk about the two options if you're in business to purchase a car. Well, of course, you can purchase it outright without any finance, but of course, that means that you're going to have to stump up the cash to buy the vehicle, and there's not going to be any interest deduction. Also, there's an opportunity cost, right? Because you could either pay those monies out if they're from retained profits, pay them out to you personally, put it in your offset account, or invest it in super or do something else with it. So there's an opportunity cost there. So that's not really probably the most attractive option. The second option, which a lot of people use, is chattel mortgage. So it's essentially where you go and get a car loan or lease. Let's not worry about the terminology too much, to go and buy the car, and then each year you claim depreciation in respect to the car. Not you, your business does, and then the business also claims an interest deduction. That's okay. That's better because you at least get a tax deduction for those expenses, albeit at 25 to 30%, depending on what your structure is inside a company. But we think there's a better option, don't we, Mena?
Yeah, so the above purchasing option, like Stuart just mentioned, only yields about a 25 to 30% deduction. So it's good, but there could be better. So we historically haven't been a big fan of novated lease arrangements when it comes to sort of privately held small businesses because the interest rates are usually higher, there's administrative costs, and the break costs can be quite substantial too. However, when factoring in the FBT benefits or the fact that it's fringe benefit tax exempt, a novated lease arrangement becomes a lot more attractive. The reason being is that the whole repayment of the car, so both the principal and the interest, the insurance, the registration, and so forth, comes out of your pre-tax salary. So that means that you're getting a 47% deduction on everything, including the principal pay down of the vehicle. Now, you probably will ask, what is a novated lease? So for the people out there that's not familiar with it, a novated lease is a three-way sort of arrangement between a lease company, your employer or yourself in this case, and you as an employee of that company. So as I mentioned, basically all the finance repayments, the insurance, the registration all come out from your pre-tax salary. Now, historically with a a novated lease arrangement, there would be both a pre and post-tax component. So basically a pre-tax component, which used to be around sort of 20% of what the total costs used to be eligible for the pre-tax component, whereas the balance would be post-tax. So you didn't get any sort of tax benefit out of it. But for electric vehicles, because they're exempt, or most are, then you can actually get the whole component pre-tax. And if you're earning above 190,000, you're essentially saving 47 cents on the dollar for those repayments. So instead of the 25 to 30% of a corporate tax rate, it's an extra at a minimum 17%. So just to put these savings in perspective, we ran a quick calculation with a novated lease provider. Now, all of them, they're all different with different interest rates and charges and so forth. But we did it on a baseline Tesla because, simply put, they seem to be a very common vehicle at this point in time. And we worked it out that if you're earning roughly about $229,000 and over a 3-year lease period, then that will cost you roughly about anywhere between $8,000 to $10,000 out of pocket per year. So that's a huge saving as to from what a normal sort of finance arrangement will cost.
Now, of course, to access this arrangement, you need to be an employee, and not every self-employed person pays themselves a salary. Doesn't necessarily need to be a market level salary. For example, if you make super contributions, usually in your personal name, just put yourself on a $30,000 a year salary, sacrifice your entire salary into super, and all of a sudden you've ticked the box of being an employee and you can implement a novated lease under this sort of arrangement. And those vehicles, could be used by other family members as well. It's just a great way, or more tax effective way and cost effective way of being able to purchase a vehicle. Also, staff might be able to utilize it. You might be able to use it as an incentive or incentivize return to office, these sorts of things. But, if a staff member is looking to purchase an electric vehicle, certainly using a novated lease is going to be most likely the best thing for them. As I said at the start, there's always idiosyncrasies with these things. So it's very important before you enter such arrangements to confirm them with your holistic accountant to make sure they're appropriate. Okay, we'll leave it there for today. Until next week, bye for now.